Great, let's get going. We have got quite a packed session today, a really exciting session as well. Today we'll be going through 3 of the 6 steps, and then we'll also be joined by Akif, who will chat around blended finance later. So again, as we have done in the past few sessions, I would like to invite you to just put into the chat how you're doing, what you learned from the last session, and then also what you're most looking forward to in this session. I think that's great. It just gives us a gauge of where everyone's at, and then also just like what are some of your expectations around the session as well. So while you're doing that, I'll just go through some housekeeping kind of issues. So obviously just the normal ones for the call. Please do rename yourself. It's very helpful just for us when we engage in interacting with you. Also when you are in breakout rooms. And then whenever you're speaking where possible, given you may have challenges with bandwidth and that, to please just have your video on so we can see you. And yeah, always welcome to post questions and comments in the chat. So just to mention, we had our first office hours with Umi. It was yesterday. And we would really encourage you. The next ones are going to take place on the 11th of August. So please do sign up for that. And also, please, if you are signing up for it, yeah, just make sure that you are able to attend, just to respect the Umi's time or whoever's doing the office hours, and also just other people as well, because the slots are secured, and then that means there may not be an opportunity for other person to join that. So please do make sure that you attend those as well. Also a reminder that there will be a 50% discount on an AVPA ticket, just a reward for one of the delegates who's really engaging, also sharing on social media and all that. So just look out for that. I think that's really incredible. I was at the AVPA conference, the inaugural one last year, and it's just an incredible conference with amazing people and content. So we definitely recommend you put that in your calendar. And then obviously with 50% discounts, it'll be great as well. Let's have a look at the chat and see. Great, Alexandra said the office hours were really helpful, and that's amazing. Yeah, please, it really is a great opportunity. If you can take advantage of it, it will be great. Great. Yeah, just a reminder, put in what you took out from last week's session and what you're looking forward to this session. I think it's really great for us to do that. So what we covered last week is obviously we looked at an introduction to deploying Catalytic capital. So in the first 2 webinars, we really looked at the foundations of Catalytic capital, defining it, seeing why it is important, then looking at the different roles and uses of Catalytic capital, where it fits on the capital spectrum. So laying some of those foundations in the first 2 webinars. And then last week, we then shift gears a little bit and we started moving towards, okay, we know what Catalytic capital is, we know it's important. How do you as an organization start intentionally deploying this? And so we looked at that and we suggested a 6-step process, noting that it's just a suggested process, right? It really will depend, but it gives you a good framework to start thinking about some of the important things when deploying Catalytic capital. And we looked at the first 2 steps of that process. The step 1 being your institutional Catalytic capital sandbox. So considering your own institution, what are your preferences, your mandates, your restrictions, and then trying to see how that then informs how you are going to be able to play in the space. So your playing field for Catalytic capital. And then the second step was looking at what is the investee's Catalytic capital ask. And when looking at the process, this informs the baseline clarity that you're looking for. And so, again, just situating ourselves in the course, we are in the 4th session. And yeah, we are over halfway, so we're almost there. And then next week, we're going to dive into completing what the 6-step process is, and then we're going to look at some case studies. Then the last week, we're going to have a look at what it means to be managing for impact, especially for Catalytic Capital. So for today, what have we got ahead of us? We've got, looking at topic 6, which is really looking at Catalytic Capital assessments. And there's two sides to this. There's doing assessments on the demand side and the supply side. And it's really great. I've got Ryan who's here and he's going to be helping me facilitate as well today. And he will be covering those first 2 lessons there. And then we'll dive into capital structure. So then how do you start structuring your Catalytic capital and what does it look like considering other investors and your investee? And then after that, we'll go into a break. And then after the break, we'll be joined by Akif, who's the director for Convergence in Africa, who's going to share with us a bit on blended finance and the role of Catalytic capital in that. Okay, so with that, I'm then going to invite Ryan to come through and get us started.
Thank you so much, Jason. I hope everyone can hear me clearly. And great to see all the comments in the chats about the different bits of last week's session that you quite enjoyed. As Jason had mentioned, we definitely started with the 2 fundamental aspects of considering catalytic capital and how you're going to deploy it, looking at the baseline, which provides clarity in terms of the direction you'll take with catalytic capital. So when it came to the sandbox, we definitely touched on the objectives that you'd have, the restrictions within which you're able to provide catalytic capital, your must-haves and your preferences. And then we shifted as well to point number 2, which is on the catalytic capital ask, with more focus on what is the specific ask from potential investees and why is that capital needed. As we go into step 3, step 4, and step 5 later on today, we want to dive a little bit deeper as we go into that assessment. So looking to see if the specific needs that are being addressed with the catalytic capital are actually challenges that are faced either at the company level or actually if it's more of a systemic and market-wide issue. So we'll want to look at the demands from the demand side, or at least the questions or items to be clarified on the demand side, but also the considerations from the supply side. So what are the market or investee needs? Can you go into a deep dive on that, and how will your catalytic capital actually address those? And similarly, when we look at the supply side of the equation, what are the investor needs and what is the expected capital mobilization more broadly to actually help address some of these issues? One caveat as we go through step 3, 4, 5, and definitely 6 as we touch on that next week is these are very iterative processes, and the more information you get around the barriers that are being addressed or the acceptable risk that you're willing to take, or even the need for catalytic capital, you'll begin to get a clear idea of the amounts that you'd be willing to risk, for example, the amounts that you'll be putting forward, the specific challenges you'll be looking to address, whether it is within the sector or across sectors, and what sort of approach you might use based on the successes of the capital you deploy to how those can actually be applied within your broader portfolio moving forward. So we'll quickly go down to the next slide as we dive a little bit deeper into the demand side. I think one of the initial questions that we'd want to ask ourselves, yes, thank you, Jason, is why is there a capital gap within the sector, or where is the capital gap that the business is facing? So as you consider this question, there are some sub-questions that we've identified that can help you to dive deeper into this. I'll have a caveat, and we have that at the bottom of this screen right now, is that it is super important to be as data-driven as possible to make sure that they are, one, the hypothesis that you're putting forward and the potential solutions that are coming up from your answers are data-driven and are reflective of the markets, the industries, or even the businesses that you're looking to invest in. So as we look at the sub-questions, the first one is, who is facing this capital gap? Is this an investee-specific challenge, which might actually speak to maybe some things that the investee may need to do better? Or is this actually a market-wide problem that actually speaks to the need for catalytic capital? More often than not, you'll find that where there are market challenges, the provision of that capital can actually help not just your investee, but can actually help other businesses align with other investors who can actually support them in their endeavors to grow and also just address systemic challenges within their specific industry. So are there similar enterprises or funds that are facing the same capital challenge? Might it make sense to pool funding in that respect? But more critically, what are the reasons for these capital gaps? So again, it speaks to the need to be data-driven and to actually validate some of your initial hypotheses through conversations with players within these sectors, within these larger industries, just to understand what are the reasons why people shy away from providing support within these sectors. What is that need for catalytic capital to address those challenges, and how is the best way to deploy it? Secondly, what are the investees or markets needs? So within this sub-question, the key thing to assess would be the needs on the level of the individual investee, the market segment in which they operate, or indeed the overall market. Again, speaking to the need for maybe the individual business to actually improve certain processes or the way that they interact with the market, or might actually be a need for a greater amounts of capital to be pulled together to actually address market challenges that cannot really be solved by any one player. And as you think about that latter point that I just raised, you might also want to think and consider about the impact that you want to achieve. So assessing the impact that would result from the use of the catalytic capital specifically on the investee, maybe within that market segment, or in the case that this is something that is actually addressed across the market, with the removal of those barriers, what impact would that actually have on the market more generally? Would that mean greater financing flows? Would that mean greater flows in a specific direction? Or that change the sort of nature of investment within those markets? We'll quickly move down to the next slide, which goes into a little bit more detail as to the need of the investments. So there's a few more items that I want to cover with respect to the needs of the market versus the investee. So here's some sub-questions that you can also consider. One, what is the current state of the investee or the market? Is this a mature market? Or is it that we have an investee who is less mature in a market that is actually quite solid? What is the specific sector or subsector? Or what are the different verticals within these sectors? What is the geography? Is this a geographic challenge? I think if we were to give the example of Africa, there are certain markets where, say, for example, agriculture is broadly quite a mature market, or one where investments tend to be quite evident, but maybe the geography is in a post-conflict region, or an area where the market systems are not quite as developed. Say, for example, countries like South Sudan, or countries within Central Africa, for example. So with that in mind, what is that analysis of the key risks? What are the primary drivers of risks within these countries? Is it more political? Is it more systems-based? Is it maybe a lack of development of the market in terms of offtake, etc.? What is the competitive environment? And what is the position within the ecosystem that you're looking to invest in? Again, looking at the example of the verticals, are there certain sub-segments within these verticals that maybe are facing more challenges? And that is where the catalytic capital is required. So is it more so on the area of market development, essentially making sure that there's enough of an offtake market to actually support the businesses that you're investing in? Or is it really just a case of building the technical assistance or providing technical assistance to actually increase the capacity of the businesses to enable them address or at least meet the needs of off-takers, for example? Then further to that, we actually look at what is the actual problem. And I think I've maybe spoken to some of those problems in the example I've just given. So some sub-questions to answer to find more detail about is, what are the key barriers to growth? Is it financial? Is it more technical? Or are there other sort of challenges out there? And what are the key failures, frictions, or gaps that need to be addressed? That, of course, will speak to the next sub-bullet which we have, which is the different reasons for the capital gap and what holds back commercial capital. Or rather flip it, what are the things that, if addressed, will actually help to catalyze more commercial more commercial involvement within that subsector? Are there actors who are missing in the ecosystem? To the example that I'd given of post-conflict states, maybe it's just a case that there are no off-takers in that case. So can catalytic capital be provided to actually help some of these larger off-takers, for example, take on more risk? Or is Is it a case of creating guarantee systems where off-takers can actually participate within that value chain or ecosystem to actually enable the businesses that you're looking to support to actually grow? And are there existing solutions? I think I've given one because I've leaned quite heavily on this agriculture and conflict or post-conflict states example. But are there other solutions that can be thought through to actually build the resilience of the investor or the investee in this case, or actually to build the resilience of the market to actually ensure that investments can actually pay off in the long term? Speaking to those possible solutions, again, some of the sub-questions here are what funding or other support is needed to actually help the investee or the market grow, expand, and ultimately deliver the impact that you're looking at. We'll dive a little bit deeper into some of the questions around what is that ultimate impact you're looking to deliver. So if you do have some initial ideas through that, it would be great to validate those with different players and get more detail on that. And then ultimately, at the end of the day, would your catalytic capital help in actually moving the needle with respect to addressing this challenge? Quickly go to the next slide, which now focuses less on the need and more on the impact. And under here, we have just a few initial sort of illustrative questions that can help you identify more about what help you to articulate better the kind of impact that you're looking to create with your catalytic capital. First question here is, does the investment proposition support additional impact? As we'd spoken about last week, one key critical component of catalytic capital, at least if you're thinking about introducing catalytic capital within your portfolio, is what is the additionality that your catalytic capital will be doing or providing within the market? Is it addressing certain aspects of the sector that have not typically been looked at? Or is it helping to actually address or further support other investors who are actually trying to address some market challenges? So from your perspective, is this dealing with, again, expanding the different aspects that have maybe not been touched on? So that's the breadth versus the depth. Are you adding to what other players have been participating in? Another sub-question under impact, now this speaks to specifically the investee, is what are the impact targets that you're looking to gain from that investee? Beyond just a successful capital raise for them, what is the investee looking to achieve? And when it comes to this, I think one of the key things to actually discuss with your potential investee, or in fact your investee, is whether they're able to articulate and quantify their impact targets. And the key thing here would be to make sure that they have tangible metrics that could actually help with the accountability, essentially what they're held against. In the case where you've provided the catalytic capital, you've helped to address some of these market barriers. What are they doing now? And what sort of targets do they have? For example, is it increasing the number of women who actually interact with the business and therefore generate economic opportunities? Is it the knock-on effects, either upstream or downstream? Can the business or the investee in this case articulate and quantify these impact metrics, and are they able to be held accountable with respect to that? Building off on that, I think, is also the investee's potential for scale and replicability. And the way that this can be looked at is, one, for the investee themselves within the sector that they're working in, to what extent would their potential for scale or even replicability be help to catalyze what other businesses are able to do within the sector? That said, you could also look at it from a broader portfolio angle or lens. With the kind of scale that is achieved with these investees, are there similar or parallel learnings that can actually be taken and applied across sectors? So, for example, if we take the example of the agriculture value chain, if we're looking at a vertical, say, for example, of maize, and there are certain barriers within the maize value chain in a post-conflict state, if you're able to provide catalytic capital that actually enables your investee to grow, are those learnings, are the learnings from that replicable within other value chains, be it beans, be it cassava, etc. But also if you have a wider portfolio, which looks not just at agriculture, but also, for example, looks at e-mobility, are there similar learnings that you could take, for example, from that maize example? and actually are able to address issues of, for example, offtake or building of the market systems, etc. So looking at the investee's potential for scale and replicability can then help you gain some learnings that you could either apply within the sectors that you're investing in or across sectors with other different investors or indeed by yourself. On the next slide, we have the example of the Japan Asian Women Empowerment Fund. But before we get to that, I wanted to give an example that we have in Africa, which is Proparco through their Choose Africa initiative. So Proparco is a French DFI that launched its Choose Africa program or initiative in 2019. And what they've looked to do is to commit 2.5 billion euros within ecosystems in Africa. So 1.5 billion euros dedicated to loans and 1 billion dedicated to equity with the end goal of accelerating SME growth. The key challenge that they're looking at more broadly is the fact that African SMEs, and I'm sure this will resonate with a lot of people, face acute financing gaps and often lack scale-appropriate commercial capital. Either the capital that's available is too big for them to absorb, or the ticket size is almost too small to actually justify them following through the investment. With respect to how they're thinking about their impact metrics beyond just the capital that they're deploying, they're looking at the number of SMEs that are financed more broadly. They're looking at jobs that are created both upstream and downstream. They have a specific interest in the number of women-owned enterprises that are supported, speaking to gender intentionality and them wanting to actually catalyze or rather address the barrier that is women enterprises not getting enough funding or not being able to scale because they're not given the same opportunities as other organizations. But another key metric that they look at is the follow-on capital or private capital that is mobilized. So by them providing the catalytic capital to actually support these businesses as they grow, what is the follow-on capital that these businesses are able to actually access after they've received that initial type of either tier support or funding? So their approach is really just looking not at the actual, not just at the amount that they're providing, but what are the follow-on opportunities that businesses that go through the Choose Africa initiative able to mobilize beyond the engagement with the Choose Africa program. We have the example on the current slide, which is of the Japan Asian Women Empowerment Fund, which is a blended fund, which provides loans to microfinance institutions, again, with a strong focus on female entrepreneurs. The challenge here would be specifically on women facing the obstacles to economic empowerment, which I'm sure a lot of people will resonate with on the call, with access to finance critically being a key barrier. The capital gap that they're looking to address through their catalytic funding is one, women facing the obstacles to economic empowerment. And the way that they've quantified it as well is that the Asia Pacific regional loan would gain 89 billion additional US dollars annually if women were able to achieve their full economic potential. So by providing that support to women, they definitely foresee the impact case of unlocking additional funding more broadly. What they've hoped to do with their impact is that by providing that financing to MFIs, and that, of course, now unlocking on lending to female entrepreneurs, what they're looking at eliminating is the barriers that women typically face of either not being able to access funding at a very basic level, but also the sort of follow-on funding to actually help their businesses scale. And beyond just providing capital, some of the impact metrics that they look at are with the businesses that end up being supported through the MFIs, what are the percentages of end clients that are female? What are the percentages of MFIs that achieve a minimum of 60% female clients? What are the percentage of rural clients? Because I think rural segments in many cases might end up being overlooked. And at the end of the day, what they're looking to do is to increase the number of female entrepreneurs broadly reached and the quality of services that are provided either to women or by women. So there's a very strong women focus throughout what they're looking at. So if we were to ask ourselves a question from a few slides back on what is the specific impact target that they have and what is the potential for scale and replicability, there's a clear focus on looking to create women-specific products by women for women. And this is across sectors with a focus on using MFIs as the anchor to actually catalyze that funding. I'll stop there to see if there are any questions, comments, or anything that resonates with everyone on the call before we dive into the next section, which is step number 4 on the supply side. But yeah, happy to stop there to see if there are any questions. Jason, are there any in the chat?
Just having a look. Also, feel free to unmute yourself and ask any questions. Do encourage that as well.
I have a quick question. This is Alex. Thank you for walking through that. I mean, I'm curious about since you focus a lot on the impact side, are they expecting the enterprises to report against all of those metrics, particularly things like quality of services? I mean, some of their demographic metrics might be easier to report against, but things like quality of service provision, how are the funds, are they expecting the enterprises to do that, or providing additional support on that, or how does that work?
Yeah, oftentimes it may be very difficult to actually monitor all of those specific things. So again, would very much depend on the capacity of the investees or even the follow-on sort of beneficiaries. So I think it would very much depend on how much they're actually willing to provide in terms of overall support for those M&E activities. But I think there's some high-level metrics that I think would be expected to be looked at. So I think there's some easier ones, such as number of women reached, either through direct financing or, for example, number of women who are able to start businesses as a result of accessing funding from these MFIs. So again, very much heavily dependent on context and the amount that you are willing to put into the M&E on the back end. I hope that answers your question, Alexandra.
Yeah, it does. I mean, my experience working with the enterprises is that they don't have the bandwidth to measure this. So if there's expectations around that, then there has to be some support provided either from the funder or someone else. Exactly. They want to. Thanks. They'd love to know, in our experience, what their impact is, but they don't have the bandwidth.
Yeah.
Hey Ryan, this is Samburu. Can you hear me?
Yeah, loud and clear.
Fantastic. Yeah, I wanted to jump in with a reflection.
Sure.
The very exciting example that you just cited. Hugely supportive of this sort of fund, and it's an area that the Gates Foundation, is very heavily invested in. As most of the participants might be aware of, the entire spectrum of gender equality, women's empowerment, but a very specific tension, if not challenge, that sometimes crops up is the challenge, particularly in mature African economies. So I'm referring to your South Africa, Nigeria, Kenya, to a lesser extent, maybe Ghana. There's a challenge around fragmentation and even duplication, because a lot of these funds tend not to necessarily speak to each other. They operate in very distinct parallels. I wonder if you can address that challenge. We've worked really hard at the foundation to ensure that our portfolios are essentially speaking to each other, right? But the challenge, I guess, is when you're thinking at an ecosystem level, you don't always have full visibility over what else is going on. And so you can easily land in a situation where you have grantees, investees, double, triple, quadruple dipping because the funds are just very fragmented and disconnected. Thank you.
Thanks, Samburu. In an ideal world, I think these sort of sessions or these sort of platforms would be what we use to actually identify the fact that people are duplicating efforts. Again, a lot of this is I guess, can be addressed through just speaking to each other and not operating in silos. That's, I guess, a broader ecosystem challenge. Oh, a wonderful reflection, Samburu. Thank you. Jason, are there any other questions in the chat? It appears people are also answering each other's questions, which is wonderful to see.
Yeah. I think just in the interest of time, yeah, I think you can continue, Ryan.
Great, thanks. So on the other hand, so we focused quite a lot on the demand side at the beginning, but I want to now quickly move over to the supply side, where we look at the investor needs and the expected capital mobilization from that end. So we'll quickly move down to the next slide, where we're looking at some of the initial challenges that hold investors back from actually participating in mobilizing and providing this catalytic capital. So here are some sub-questions that you can consider as you look at whether or not you might want to participate in this. So one, who would be coming in, or who could come in? Sub-questions under this, and this actually speaks a little bit to Samburu's point just now. Has any investor already expressed interest or is already sort of participating in the space? If so, what is the status of those discussions, or what is the status of the sort of investment that they will be providing, or catalytic capital they'll be providing? Are there other investors who've indicated interest with respect to certain focus areas, or have they done prior similar investments, which would then mean that if you provide it, you'd really just be duplicating stuff that they've done? Is there an option to collaborate with them to actually, given that they've had the proof of concept, to actually build off what they've done, to actually bolster the sort of catalytic capital that they are providing? A second question that we could look at, as well as you consider what is holding investors back, what are the investors' needs and the constraints? Speaking again to the sandbox that we discussed last week. The factors here that would be relevant when you look at the needs and constraints are their risk and return appetite. I know we'd spoken quite a lot about this last week with the example of, for example, BII, who had that 30% risk that they have, or the 30% allotment of risk within their total portfolio. The minimum size requirements, any regulatory requirements that constrain the amount that they can actually provide versus what sectors they can play in, or what countries they can focus on. Are those needs or constraints clear? And is there room for negotiation, either by providing a track record or traction data, or by proving that there are other players who are around to actually make them more willing to participate? Speaking to the last question, which is, how can you get other investors to contribute capital? So how can your catalytic capital address the investors' needs and constraints? By providing certain capital, will you be able to allow them to actually participate in some of those buckets that they typically shy away from? Again, speaking to the additionality, the breadth versus the depth of what your catalytic capital is providing. We'll be able to come back to the example that we have with the Japan Asian Women Empowerment Fund, that's JAWEF. Again, we talked about how it's a blended fund that provides loans to microfinance institutions that then serve female entrepreneurs in the ASEAN region and beyond. When it comes to the potential investors that they'd looked at, they'd identified Blue Orchard as a good fit because of its proposition with the Japanese governmental institutions. That's namely JBIC and JICA. And there was a strong mandate alignment with respect to this. Again, the focus on women's empowerment, helping to create financial products, or just providing financial services to women by women. And that opportunity to actually mobilize, that opportunity helped identify, at least drive the opportunity to mobilize more Japanese private investors. So with the backing of those two institutions, as mentioned, Blue Orchard had identified that subsegment of institutional investors from Japan as an interesting group. So targeted investors domiciled in Japan for the fund's senior capital layer. So what are the different investor needs? So on the one hand, there was the mandate alignment, in particular for JBIC, where there was the focus on the support of the interests of the Japanese private sector. The mandate alignment, of course, here being the focus on women empowerment. Similarly, there was the small risk support and manager alignment. We also had other institutional investors who wanted significant risk support and wanted to be able to diversify. But for all of these investors, one thing that they really wanted to make sure that they could actually participate in providing this catalytic capital was an experienced manager. So speaking to the investment credentials of Blue Orchard, given that they had a significant experience, they actually emerged as a good partner to drive Jawa forward. So when we go to the next slide, and this now speaking to what are some of the things that were done to actually help attract investors. The main thing here was, of course, the mandate alignment. That's what we have on the next slide, sorry, which in particular had that clear focus on Japanese institutional investors as that anchor to helping to unlock financing for women entrepreneurs. Then there's the small risk support through the 500K first loss layer that will be provided by the manager and Summit Financial. Then in terms of additionally attracting investors from the institutional investor side, there was the diversification opportunity, of course, looking at the ASEAN region and looking at supporting women through microfinance. Then there was a 50% subordinated capital mezzanine that was provided by JBIC and JICA, and the first loss layer that was provided by the manager and Summit Financial. Additionally, there were the higher returns that were promised. That was, of course, higher than the concessional junior tranches. And then, of course, the fact that we mentioned that Blue Orchard is an experienced manager with that track record and an extensive regional network to be able to actually fully reach out within the ASEAN region, investing those MFIs and working with those MFIs to actually get a good portfolio of women entrepreneurs to actually access financing. So all of these items that we've covered on the last slide and this current slide are items that should be thought through. What are the different types of investors that you'd be looking to gain, and what is the value add, the additionality, and what are the other sort of incentives or benefits that they would derive from engaging you in terms of providing catalytic capital. We'll stop there for any questions or any additional comments.
I see there has been in the chat around outcomes-based financing. I think this is more related to whether outcomes-based financing can be defined as catalytic capital around the definition. So yeah, I think in its traditional sense, outcomes-based financing, so for instance, like social impact incentives and where it's kind of just grant capital that is paying out for outcomes. A lot of the time, especially social impact incentives, it's not investment capital and there's no return expectation on it. So it is important, like we said, with philanthropy, where you're able to, where you're able to use that, and it can be catalytic. So it can, at a later stage, crowding capital, it can create impact. But if we're looking at what we said for this course as a definition around investment capital with the return expectation, then but then that caveat was obviously in a structure, blended finance structure. So I think if you are looking at outcomes-based financing in a kind of a structure with blended finance and that, then I think there is some room for you then to consider catalytic capital. But yeah, generally it's not considered according to the definition which we have expressed in this course.
Yeah, Jason, if I can come in here for a second, this is Vandana here from SNV. You know, you remember like I am part of something called the Dutch Fund for Climate and Development, and we have a combination of grants, technical assistance, and we can provide debt or equity for private sector companies. Now, as much as there is grants within the structure, and there's also technical assistance, we still would not consider DFCD as a catalytic capital, because the idea is to get investments using the grants and TA, but that investment is very market returns based. It's a bit concessional in the sense in terms of time, in terms of return expectations, but it is definitely just like how Adenia was presenting, I think it was very similar in the idea that it is still market-based return expectations of sort. So somehow this definition of catalytic capital and considering outcome-based financing, most of the time it's based on grants, deployment and stuff. It's just the confusing part I think we were talking about in the chat was about when is it being considered total grant financing and when is it actually catalytic capital?
Yeah, and I think it's I think when we were chatting around the definition, it was one of those sticking points, right, around grant capital and its role in it. But I think if we want to keep to what we've put as the definition, in that we do acknowledge the importance of these grant sources of capital, such as outcomes-based financing or that. And there is a view to be more inclusive of that. But I think for the sake of this content in this course, let's really do think around catalytic capital as that investment capital. So you're looking at that capital which is taking on disproportionate risk or below market rate return in the way it's deployed. But not putting aside any of that conversation, right? I think it's very important, and we do acknowledge the importance of that outcomes-based financing in the form of grant capital as well.
Jason, this is Urmi. Can I step in for a second if you have 1 minute?
Sure. Yeah, I'd love to.
Yeah. Thank you. And Vandana, thank you for that comment. And this is such a great discussion. I apologize for not being on camera. I think, to this discussion about sort of where grant funding or predominantly grant structured models are catalytic or not, I would say yes, think about that question, but that is a starting point really for what you're trying to do, right? So if the funding and the capital is acting as catalytic capital, is acting as investment capital, you really want to treat it with the lens of investment capital, right? Which is what I think all the parts of the framework that we talk about here are. Grants that give you TA, that perform a variety of roles in early stage financing and in setting up nascent enterprises and models are very important, right? And they sit around the structure. So I think it's really thinking about what the goals are and then how you want to treat that process to get the most value for the recipient and for you as the provider. One of the reasons initially we put the definition together, we spent a lot of time debating the definition before it was finally adopted and Tideline did its paper, which was, when C3 was launched. And the only thing I would say is sort of, yes, it is important to understand when things qualify or don't, but also to kind of go to the next point of what that means, because for those of you who have been in impact investing for decades like me, you will know that even today there is a lot of conversation about what is impact investments and what is not, right? So we kind of don't want to stay very focused on the definitional aspect unless you feel like it creates so much confusion that it stops us from moving forward in understanding and executing that process in a way that meets the goals of all the parties. So does that make sense? So it's a little bit of a balance of saying, yes, we are rigorous and somewhat focused about what the definition is, but at the same time, using the definition really as a tool to take us to the next piece, right? So I would always urge you to sort of, spend some time thinking about that question and then really move to sort of the following questions, right? Whatever they might be. Because one of my fears is that otherwise we tend to get very caught up in sort of trying to understand when it qualifies and when it doesn't, and how we should really approach that sort of definitional clarity. Is that helpful? I hope that's not creating more confusion.
Thanks, Amy. I think that is very helpful.
Yeah, and Jason, and everybody, just feel free to put stuff in the chat if you want to have a little bit more conversation around this, and we'll figure out a way to make sure that we connect with you.
Great, thank you. So I'm going to quickly move on to step 5. So it's the final step. And so really looking at, once you've done your capital assessments, then you start thinking around, okay, what is the structure you're going to use? What are the different terms that you're going to use for this particular investee, and also considering the investors as well. So trying to see how you can mobilize or crowd in additional capital. And so this sits at step 5. So there's 3 main sections you want to consider here, or the sub-questions. First, you want to consider what are the options that are there and available. Then you must look at, are the proposed capital structure and terms adequate for what you're trying to achieve? Then lastly, what are some of the influencing factors determining how much capital is needed in a capital structure? So we're going to dive a little bit deeper into each of these. So the first one is looking at what are the different options available. And so Tideline suggests 5 Ps, and this is divided into 2 categories, broad categories. You have return, and when you're speaking about return, you're really looking at kind of the price and considering whether you're able to accept below market rate return relative to the risk. So thinking around the concessionality with this particular transaction. And then you have 4 other Ps which are related to the risk and trying to maybe mitigate for some of the risk in a transaction. And so you can look at pledge, where you're providing a credit enhancement via guarantee. You can look at position, where you're trying to take on more of a junior position or subordinated debt or equity position. So just trying to enhance that for potential investors that are coming on board, by maybe offering them a senior position in the capital stack. And then you have patience as well. Are you going to accept a longer timeline or tenure just to account for that additional risk or that time that's needed to innovate and the flexibility that may be needed for that investee? And then also a purpose, so accepting non-traditional terms such as no collateral. And so, yeah, these are different options you can consider when you are trying to figure out what is the best way for you to reduce risk or enhance returns for others. And so these are some of the options that Tideline suggests. And then the second part is, are the proposed structure and use of capital a fit for purpose? So then considering, you always have these 5 Ps, but then you've got to consider, okay, is this particular capital structure that you are looking at adequate? And the starting point is obviously first looking at the strategy. So considering the strategy of the company or fund, and then what is their risk and return profile? And this may determine what capital is needed. So are they quite risky? So then you will consider, okay, then how do you de-risk that? Is there potential for not a lot of return? So then how do you then enhance that return? Is there a need for patience as well? So just considering what is the strategy for this company, how long they're going to need to get to that point. So if you think about the transient kind of life cycle where you're going from seeding to scaling, and thinking around that as well, how are you going to do that? Then you're looking at the availability of capital, and this speaks to the scarcity of capital, and then considering the different tools and the constraints and flexibility that capital providers have, and this can influence the structure chosen. So if you think back to step 1, we were looking at your capital sandbox. Certain capital providers only have a certain amount of tools, right? So certain instruments that they're able to use, and they only allow certain amounts of flexibility as well. So you'll need to consider that and consider the availability of that type of capital. And then the last one is to look at needs and constraints of other investors. So Ryan spoke about this a bit earlier, so I'm not going to dive into that in too much detail. So the last question here is then looking at how much capital is needed. And so as mentioned earlier, the leading factor, you should look at the risk and return of the investee. So Ryan provided some really good examples around particularly agriculture in some of these conflict type areas where it may be seen quite risky, and the risk return profile would reflect that. Asset intensity is another one, customer profile. These are different things that you would need to consider with the investee and their strategy. Management experience, stage maturity. So for instance, with Blue Orchard, they had quite a good manager there, and so there's quite a lot of experience there. So this also affects the ability for certain investors to come on board, right? Affects the risk and return profile there. And so there's other factors as well that you need to consider. So investor needs, so considering different investor types, their regulatory requirements, their mandate objectives. A lot of these things you'll see that we've gone through previously and they're coming up again. So reinforcing the importance of actually having these things top of mind. So ambition for impact and crowding in. So more impact often means more catalytic capital is needed. And also if you want more crowding in, it often means that you need to think about how you're going to enable that and provide risk mitigation for potential investors. Yeah, and then perceived risks, and this speaks to data as well. So sometimes there's a perception of risk, which may not actually be true because there's a lack of scarce data. So then it may be important to consider that, and that would then mean that you have to provide that capital because there isn't that data to address those perceived risks at this stage. Precedents as well, so you can have a precedence of a similar transaction or capital structure being used before, and then you may assume that you just need to continue doing it. But like as we said, we want to reduce catalytic capital over a period of time. So if data is taken, you're able to then justify using less catalytic capital going forward. So it's just to have that top of mind as well. Then the last point is speed. So sometimes it's helpful to actually just provide a generous amount of catalytic capital to make a no-brainer investment opportunity for potential investors. And that way it will speed things up in the process of actually unlocking capital for potential investees that are going to create impact. So what I'm going to do now, we are going to go into breakout rooms. And in the breakout rooms, I'm going to ask you to read through this case study. And I would like you then to discuss these following questions. So the questions are going to be using those 5 Ps that we've gone through, which is price, pledge, position, patience, purpose. Identify where in the case study you see that they are applying one of these different options or tools to help with the capital structure. And then I also want you to consider from the case study, what is the risk return profile of the investee, investor needs, impact, crowding in, ambition, perceived risk, precedence, and speed. So we went through these in the most recent slide, and then just apply this to this case study. Okay, let me just check the time. We are at 6 minutes to. So if we can, I want to try to give you guys enough time to go through it. So if we can do 8 minutes, and then we'll come back for a 2-minute debrief. So let's get that started as quick as possible. From the AVPA team, if you can start breaking us out into breakout rooms, please. Welcome back, everyone. I think almost everyone has returned. And yeah, so just quite keen in the last 3 minutes to hear any thoughts or almost like a debrief. So share with us if you are keen, what was your group's thoughts on where they were using the different 5 Ps within that particular case study, and then also around the different influencing factors that you identified. Anyone want to share?
Listen, Vandana. Oh, sorry, Rose.
Go ahead, Rosalind.
Okay, great, thank you. I'm going to try and be quick. And with my team, we had Kudzai, Nyakalo, Jean, Victor, and Rado, if I'm not forgetting anyone. We mainly focused on the first part of the set questions. And then in terms of the 5 Ps, the price was, we thought it was linked to the 2.25 target dividend, which we thought might be probably concessional. For the pledge, it was linked to the first lot part of the investment structure and also the junior and mezzanine tranches, especially from JICA and the other entity. For purpose, the fact that it was focusing on women and economic empowerment, and then patience, the longer tenure and concessional returns of the men standing trenches. And then the position again, some of the investors are more senior and some more subordinate in the stack. And I think Beto mentioned that the catalytic position of the mezzanine part in the first loss in total, like the 120, was quite high in terms of catalytic and also quite generous. So I think that covers most of what we said. Thank you. Sorry, Vandana. Please go ahead.
Great. Thanks a lot, Rosalie. Vandana, you want to add?
Yeah, so we were discussing about the purpose. I mean, I think the 3 Ps were very clear, like the first 3, in the sense that it is the price, the position, and the pledge were clear. But the patience, of course, the tenor and timeline was not very clear, so we did not touch upon that. But the purpose was about accepting non-traditional terms as collateral, right? Like that was the definition that was given. And that purpose was also not very clear from the 3 sub-bullets that we had here, in terms of being both first loss and mezzanine shares were issued on concessional terms, but there was no specific mention of so that purpose was not very clear for us. Everything else was what Rosalind mentioned were spot on, I think. Yeah, thanks.
Great. No, thanks so much. That's good feedback. So, I mean, just going in position, which was mentioned. So obviously taking on a mezzanine layer, taking that position there. And then you also have prices being concessional. And then we've also got a position taking the first loss, right? Taking on there. So, and I think also what I want to say is that this is just like kind of, I think there's a lot more if you dig deep into the case study where you could potentially find others. So I think around purpose, like non-traditional terms, I think what's quite interesting on the last bullet point, you see it says to accommodate diverging senior investors' needs, 3 types of senior investors were introduced, ranking pari passu, but with different durations depending on closings and target dividends. So the different durations was probably linking to the different purpose of the different investors and trying to meet what that is for them. So maybe not traditional in some of the terms that were offered to the different investors. So then thinking around that, how you can look at your different investors' needs and then take on different terms and that. So I hope that provides some clarity. Like those ones are a little bit more trickier, like you said, patience and purpose within this particular example. But yeah, I think with this whole thing of capital structuring and that these are all a lot of options which you can use. And then once you do those different assessments about demand side, supply side, you can actually be quite creative in how you use these different options to make sure that you are actually meeting the needs of both the investee and the investors to try optimize for the capital structure. So I'm going to stop there.
So Jason, one quick question on this, because there are 2 positions and 1 price that you mentioned, but the first position, like the Blue Orchid and Summit Financial, provided a moderate first loss layer to cover the foreign exchange. Can that also be considered a pledge, in the sense that I was just wondering, because it is sort of providing a credit enhancement of sorts, so it's just to
yeah, so I think like it really depends on the actual terms of the first loss. So it's like first loss shares and that. So if you look in the details, you could probably see if there's a pledge to that, or it's more of just kind of a position within it. So I think it's a good question. But yeah, I don't know if anyone in the group has some thoughts on that, or opinions on whether you believe that's a pledge or just purely position. Okay. I'm not seeing any responses on that, or any thoughts. But yeah, I think just the devil's in the details in terms of actually seeing what the specific terms of that first loss and shares. Because if you think about, like you said, Mandana, it's a credit enhancement. So if it is enhancing that, then I would definitely say you can say it's a pledge. Okay, I am going to stop there. Okay, well, I forgot we have 2 more slides, but I'll race through these quickly. So essentially, like I've said, there's no formula for the best structure. It really depends on the willingness of the actors around investment table to engage, share information, and seek a solution, right? And also willing to compromise on certain components. Use data, so really be data-driven in how you are setting it up. And so you want to also minimize the use of catalytic capital and push the boundaries with commercial investors. Involve the investees. So as we saw in the beginning, you also need to consider the investee, the risk and return profile, the geographies and all that. So it's important to involve them as well. Then consider your chair. So what role do you want to play? What position? And then consider the amounts as well that you're going to put in. This is also very important, is to consider the potential negative effects as well that you may unintentionally do through this, right? So, but it's to be intentional about considering these as you're structuring now. So are you crowding out others? So looking at market distortion. So thinking around at the investor level, are the investors unable to compete with the catalytic capital terms and therefore effectively staying away? So you come with extremely favorable terms, and then other catalytic capital investors are then crowded out. At a market level as well, are you then making this investee company quite like able to provide favorable terms, right? Because of the investment of catalytic capital, which then provides them with an unfair advantage, which would then crowd out potential competition as well within the space. Then the last one is breeding lazy investors. So is your catalytic capital coming in and de-risking investment, but then these investors would just become reliant on your catalytic capital. So that speaks to that thing of actually transitioning away from catalytic capital and making it that they will put forward their commercial capital. So really important. I'm going to stop there for a quick break. Given we are over time, if we can come back at 4:20, if that's okay with everyone. Apologies for the little bit of a rush and the fast time. So again, 4:20, and then we'll have Akif, who will be chatting to us. Really looking forward to that. Okay, 4:20. Welcome back, everyone. I hope you are back. I know that was a really quick break, but yeah, thank you so much for hanging in there. I'm really excited that we can have Akif join us. But before we do that, can we maybe just see a few faces, maybe a few reactions, just to see that everyone is here and with us? Great, a lot of thumbs up. Fantastic. There are some blank screens, so come on. Thanks. Thank you, everyone. Amazing. Yeah, I am going to see if Akif, yeah, I can see Akif. How's it, Akif? Really good to have you. Yeah, super excited to hear. So as you might have seen in the bio slide, Akif is the director for Africa on Convergence. Yeah, really incredible, really good friend as well. And so really excited to have him speak to you guys today. So I'm going to hand over to you, Akif.
Great, thank you, Jason, for that generous introduction. Can you hear me and see me clearly? Brilliant. And thanks, Nasri, as well. It's good to see you. Thanks to both of you for having me. I appreciate this. And I was just looking at this on the screen and looking at some of the names, and I see some familiar faces, Afua, Rosalind, Reto, and others. So it's good to see all of you and be here with you today. I guess I have a pretty broad remit, a broad brief. Jason and Nasri have said catalytic capital considerations. That's what you're supposed to be talking about. So we've got up until 5 o'clock South Africa time with all of you. So I'll keep my comments brief because I want to hear from all of you. I want to also engage with you and give you a chance to ask questions, give you a chance to debate certain issues that we come across in the space. Maybe I'll just quickly reflect on some of the comments that Jason and was making earlier with respect to the assignment that you had and the 4 Ps that Jason introduced you to. I think it's helpful to remind ourselves that the other 4 Ps out of the 5, everything but price, is actually in relation to some degree to the price of a specific instrument or a specific transaction. So let me give you an example by what I mean. Let's say patience. In most transactions in Africa, you won't find banks that will lend to you beyond 5 or 6 year money. Let's say I have an investor that comes and lends to me for 8 years. If a commercial investor comes and lends to me for 8 years, they would expect to be compensated for that additional time risk or the time factor. If they're not compensated for that, then it becomes catalytic. So it's really important to think about pledge, position, purpose, and patience to some degree, and relate that back to price. Another example is a guarantee, and I think that would fell under the purpose sort of basket over here. If you think about guarantees, you can get guarantees from a range of different organizations. What you can't get from them is concessional guarantees or guarantees that are priced in a way that are not reflective of the underlying risk. So again, the point I'm trying to make is pledge, position, patience, and purpose. These are relatively easy instruments to find in the market, but their relation to price, and if they're non-market in terms, that is when they're actually catalytic versus just being something to do with pledge or position. So just helpful to think about that and relate that back to pricing. I just wanted to make that comment, and hopefully I was able to explain that. I have a sort of a series of slides to share with you. Let me see. Hang on a second. Jason, okay, I'm gonna share it myself. Can you see my screen? Yeah, good. Okay, I'm gonna ask all of you a question now. This course is about catalytic capital. I guess my day job involves talking about blended finance. So maybe you can tell me what's the difference between catalytic capital and blended finance? Any brave volunteers? What is the difference between catalytic capital and blended finance? What is the distinction? Good say?
I think blended includes all forms of capital, which would be traditional capital and catalytic. Then when you look at the total pool, that's blended. Yeah, catalytic capital is basically this, as Jason was describing, the disproportionate risk or below market returns. So that's how I see it.
And then what is blended finance? So you've articulated catalytic capital to some degree. Well, what is blended finance then?
Well, this is my layman's definition. It would be.
All right.
It's the total or the mix of capital that a project or a company requires for it to achieve its targeted outcomes, investment or impact.
Okay, correct. And then anybody else wants to take the next question? How is that different from public-private partnerships?
Public-private partnerships don't necessarily include a capital component. I mean, they could be.
I
They
don't know.
could.
I don't know who's saying this, but yeah, sure.
Sorry, I'm Alex.
You're right. Okay, Alex. Okay, yes. Sorry,
Hi.
you just popped out my screen. Hi, Alex.
Hi. So I guess it depends on if you're talking about a public-private partnership. There's so many different modalities of that, but they don't necessarily always include a capital
Correct.
component.
Good. And then how is blended finance different from impact investing? Anyone? How is it different from impact investing?
This is Fatima. Again, this is probably going to come out as a bit of a word salad, but is it
That's
the
all right.
fact that for blended finance, it involves the mixing of public funds with philanthropic funds? So it's the addition of philanthropic funds to mobilize then that private capital for development aligned goals. And impact investing in itself doesn't necessarily need to have a philanthropic component.
All of you are right in some way, shape, or form. Definitions matter. And it's really, really, really critically important for all of us to be really crystal clear on first principles and how we define things and how we articulate things. Because as you build on this particular session, this particular course, or other concepts, it's really important to have a strong grounding in terms of what all of these different definitions mean. So let me help you think through this a little bit, or at least let me tell you how I think through this. In my mind, blended finance is nothing more or nothing less than a financial structuring approach. So if you see here, it is the use of development funding. It is the use of catalytic funding, essentially, or catalytic capital. So it's the use of development funding from public and or philanthropic funders with the express intent and purpose of mobilizing additional investment from private capital into various different structures on market terms. So blended finance is nothing more or nothing less than a financial structuring approach. Catalytic capital, which is the gray circle at the bottom of my screen, is essentially the patient, flexible capital that accepts a disproportionate risk or lower returns, with really the goal of enabling and mobilizing third-party investment into transactions. So all blended finance deals include catalytic capital, but not all catalytic capital needs to be necessarily involved in all blended finance transactions. So hopefully that makes some sense. Public-private partnerships, and I forgot the name of the lady who mentioned this, but public-private partnerships are a contracting approach. And she was right. You have to look at the details. It's nothing more, nothing less, again, than a contracting approach. Does the contracting approach have concessionality embedded within the terms and conditions? If it does, it falls within the realm of blended finance. If it doesn't, and not all of them do, then it's a pure contracting approach between two entities to achieve certain outcomes and to achieve certain objectives. And impact investing, and again, there is no agreed upon definition as such, but impact investing is an investment philosophy. It's an investment approach. It is me saying, I'm going to put my money to work in a way such that I will achieve certain development impacts. I'm investing with intentionality, and I'm able to accept returns that are below market or sometimes close to market or near market. So blended finance, financial structuring approach, catalytic capital is the funding that enables this to happen and enables private investment to be mobilized using blended approaches. Public-private partnerships are a contracting approach, may or may not be blended, and impact investing is investing as an investment approach, as an investment philosophy. It's investing with certain intentionality. This is really important because I've often heard these terms being used interchangeably. People often conflate these terms, and so it's really important that we get the basics right. Maybe I'll ask you this question then. why do we even need to have a conversation about catalytic capital? Why is catalytic capital even needed? Why does a public funder or a philanthropic funder need to come into a transaction, need to put their money to work, accept disproportionate terms, accept non-market terms, whatever terms you want to call asymmetrical terms? Why do they need to do that? Arguably, public funders are custodians of precious taxpayer money. So let's say from an official development perspective, if I am investing in the Japan ASEAN Women's Empowerment Fund that you all spoke about earlier, that is one less dollar that I have, if I'm the government of Japan, to do other things that are related to official development assistance, like, for example, education-related activities, humanitarian activities, agriculture activities, and so on. So why is this necessary? Why are we even having this conversation?
There's not enough philanthropic and foreign assistance money to do what needs to be done. This is Alex again. Partnerships.
Yes, Alex, hi. No, you're right. There isn't enough official development assistance money. It's in fact was about $280 billion last year, the year before that, and it is plateaued and it's definitely decreasing. This year we're going to see much smaller amount. And it's also important to remember a decent proportion of that official development assistance is now used by donors for in-country refugee spending. So that was something that was changed in the Ukraine crisis. And so a lot of countries changed that in a way that they wanted to meet their 0.7% obligations, or at least show that they were looking to meet that 0.7% obligation. So yeah, you're right. It's definitely decreased, and we're going to be seeing with fiscal pressures, with defense pressures as well. We're going to be seeing that plateauing or decreasing over time. But why should governments be in the business? Why should foundations be in the business of mobilizing additional private investment? As I think the question that I was looking to ask. And you probably have heard of this, SDG funding gap is X, and the amount of total assets in the world is Y. And let me just tell you, there's a lot of funding in the world. There's a lot of total assets under management. If you look at the treasury markets, if you look at private credit markets, if you look at private equity markets, there's a lot of capital in the world as a proportion of the SDG funding gap. So why? So then again, another way to phrase the question is, why isn't that capital flowing to where we want it to flow to?
Could I take a crack?
Yes, please.
Yeah.
Are you referring to the misalignment between private interest in terms of commercial returns and development of social priorities? So think in terms of critical funding to health issues such as vaccines, as an example, critically important for reduction of, say, child mortality. But oftentimes, as we all know, that's not necessarily something that big pharma is going to be interested in funding, simply because the returns, particularly when you're thinking in terms of neglected tropical diseases, and as an example, it's not an area that a lot of pharmaceutical companies are going to be wanting to invest their R&D capital.
No, you're right about that. That was, I guess, another way to think about it. But I was specifically asking, when I'm talking to investors in Frankfurt, Toronto, Tokyo, Singapore, New York, even Johannesburg, even Nairobi, even Lagos, why aren't they investing in transactions, in projects, in countries that we all want to see them investing in? Essentially, what I'm trying to say is, when I speak to all of these folks, all of them tell me a couple of different things. They say to me, look, number one, it's not my job. My job is not development impact. My job is financial returns. My job is, I'm a fiduciary investor. This is my responsibility. This is my job. I'm talking about institutional investors. Some of them tell me, okay, I'm interested in investing in this to diversify, but show me product show me investment opportunities that meet my criteria. And if I'm Sanlam, or if I'm Old Mutual, or if I am the Equity Group or others, I need opportunities of a certain ticket size. Many of them tell me, you know what, simply the underlying risk of investing, and I'm talking about this from an Africa perspective, is just too high. Do you know which 2 countries in Africa have an investment grade rating?
Sorry, Akif, I just noted Kudzai had his hand up for quite a while.
Oh, sorry, I can't see. Yeah, sorry, I
no
can't see who's got their hand up.
No
Sorry,
worries.
Kudzai, go ahead.
Yeah.
Yeah, let me gather my thoughts. So, for me, to your question, if I got it right, is catalytic capital de-risks the investment. I think there was an example earlier on the first session where in Ghana there was a cancer hospital, and it got that was the first. It got funding because there was catalytic capital in there, which allowed the crowding in of private capital. So in summary, traditional capital is shy where it's not familiar with the risk and return profile. So the catalytic capital acts as insurance to traditional investors to bring in capital.
Absolutely. So you hit the nail on the head. That's exactly why we need catalytic capital. Arguably, all of this should be functioning, should be operational, should work on a pure market basis. But there are market failures across the various geographies we all work in, across the various sectors that we all work in. So we do need this development funding, catalytic capital, call it what you like. We do need these pools of money to come in and to do exactly what Kudzai said. We have on the call with us Afua from the Ghana Infrastructure Investment Fund. The Ghana Infrastructure Investment Fund is set up and capitalized by the government of Ghana to the tune of around, I believe, Afua, correct me if I'm wrong, around $345 million. And the entire mandate or raison d'etre of the Ghana Infrastructure Investment Fund is to use that precious capital that the government of Ghana has given them to mobilize and bring in and de-risk other investors from the global north into Ghana, but also the Ghanaian pension funds. There's a serious amount of pension money in Ghana. Most of that pension money is deployed and invested in Ghanaian treasuries or real estate. It's not being invested in hospitals. It's not being invested in special economic zones. It's not being invested in cold storage for agricultural value chains. So the GIIF's job is to use the various instruments and the tools that they have, which includes guarantees, which includes first loss or subordinate debt, to mobilize and to bring in those investors by essentially what Kudzai again said, by changing the risk-return ratio for those investors, so that they would look at those transactions that they would otherwise not look into. So that's essentially why we need these kinds of pools of capital. And again, I don't want all of us to have this conversation around we need only OECD money to be de-risking. Oftentimes, as the conversation is, we need the global north to come in and de-risk transactions in the global south. There is capital in the global south that we have. That's from philanthropies and from governments. And I just gave you one example, whose job it is to de-risk. And arguably, it's Jason's job, it's Frank's job, it's Nazri's job to bring in some of this additional capital into this conversation to educate the Sterling One Foundations of the world and other foundations in Africa so that they can play this role. We can't just have the Shell Foundation, the Rockefeller Foundation, the Gates Foundation doing all this. But anyways, the point is that there are disproportionate risks and returns are not commensurate then to those risks. And we need these pools of capital to come in and to de-risk and to structure around these challenges. We'll skip through some things because we've got a limited amount of time. I do want us to think about a couple of different things. There are a couple of different ways to think about blended finance. You can think about blended finance at a point in time I can blend different pools of capital at a fund of funds level. A fund of funds is essentially a fund that invests in a range of different underlying funds. So you may have heard of, for those of you working on the continent, the MasterCard Africa Growth Fund. The MasterCard Africa Growth Fund invests in a range of different underlying funds. So I can blend at the fund of funds level, I can blend at a fund level, I can blend at a project level or a transaction level, or I can blend across all of those three levels. That is me blending at a point in time. Imagine a project life cycle. Imagine I am setting up an independent power project in Nigeria, as an example. If I'm setting up an independent power project in Nigeria, I would need to do feasibility studies, technical studies, sign a power purchase agreement, land acquisition, because there's a limited domestic manufacturing sector in Nigeria that manufactures components. I'll have to import a lot of that, so there'll be import challenges at the ports and so on and so forth. So there's a lot of risk at the early stage of the life cycle of a transaction such as that. So if I am in possession of concessional money, like the Private Infrastructure Development Fund when it comes to infrastructure, or other government entities, like, for example, even the Ghana Infrastructure Investment Fund, I can bring in my precious concessional money and fund these feasibility studies, support these transactions with some early stage equity on disproportionate terms, really putting my concessional money to work such that I get the transaction to the point of bankability, so that when it is generating electricity, when it is selling power to the grid, and then when it is getting paid on a regular basis, I can ramp off that concessional money and ramp on that commercial money and bring in banks to refinance the transaction and so on. So again, the point here is you can think about blending as something that happens at a point in time, like I showed you in the previous slide, or something that happens across time. So there's a couple of different ways in which to think about this as well, which I think might be illuminating in some way, shape, or form. Now, as we spoke about earlier, there are a range of different risks and that emerging markets face, that we all face here in Africa. And if I look at on the return side of the equation, where I am in the capital stack, if you just remember the JAWIF example, where I am in the capital stack, am I senior, junior, mezzanine, so on and so forth. Where I am in the stack will have a impact on the kinds of returns I'm looking to expect when it comes to blended finance. Because again, if I am subordinate to somebody else, therefore I'll be willing to be, well, therefore I'm protecting somebody else, therefore I need to be compensated for that in pure financial terms. Of course, not in the terms of a blended finance transaction. So seniority matters in terms of something that drives returns. The duration of an investment is something that also drives returns. If I'm investing in a equity transaction, or I'm investing in a business, or I'm investing in private equity transaction, who I return my exit is a function of will drive returns. The growth rate of the business will drive returns, and so on and so forth. So there's a variety of different variables that drive returns. That's important to think about. If there's nothing that you take away from this conversation, remember the following line. Risk and return is the most important paradigm along which investors make capital allocation decisions. And therefore, blended finance as a financial structuring approach is doing nothing more, nothing less than shifting and or mitigating those risks and or enhancing those returns such that you provide those investors with risk-adjusted returns. That's the most important thing that to understand and to take away from this entire conversation. So you saw that imbalance in the previous slide. Through blending, we're shifting risks, mitigating risks, and or managing returns. And we spoke about, you can see some of the 4 Ps manifest themselves in some of these examples here, whether it is insuring against unforeseen events. To some degree, it's like a guarantee or an insurance. Improving creditworthiness is a guarantee, essentially. Limiting downside loss exposure is first loss. Eliminating funding shortfalls, that's viability gap funding. Think of technical assistance in this interesting way. If I am providing technical assistance, let's imagine a fund like the Japan ASEAN Women's Empowerment Fund. If I am and it's a pure, let's imagine it's a pure commercial fund, and I am providing technical assistance to the investees in a fund to help them be better businesses and so on and so forth. If it's a equity fund, I'm providing technical assistance. My theory of change is those businesses are now better managed, they will grow faster, they will grow better, and they'll make more money for the private equity firm. If it is a private credit firm, and I'm supporting these businesses with technical assistance, then my hypothesis is that, or my theory of change rather, is that it will reduce the probability of default for those businesses. So even technical assistance sitting outside the capital structure or advisory services can be thought of as a shifting risk play. You can also provide incentives for successful performance outcomes if you want to manage returns. And I know Reto used to do some of this work back when he was in the Swiss government when it came to aligning performance incentives and really pushing for development impact. Oftentimes you could give a business a loan and say, if you hit certain development targets, you pay me back 6% instead of 8%, or you can have somebody else come in and buy down that risk if you're not willing to take that on. So there's a variety of different ways in which you can shift risks or manage returns. And this is just a sliver of the menu. We'll skip through this. This doesn't need to be covered. I think I covered this earlier. Let me show you or talk you through maybe some of the various different ways in which one can actually blend. So we've covered that to some degree before, but this actually is a longer list. It's also important to understand that these various different instruments or archetypes don't live by themselves. Oftentimes you will have a transaction that has a first loss layer and that might have benefited from some design funding or preparatory funding to get the transaction to the point of bankability. Oftentimes you might have a transaction that has a guarantee wrap, but that also might have some sort of an interest rate subsidy to the lender. So these do not exist in isolation. They're not mutually exclusive. You have transactions that call upon a range of these different instruments. What's important for all of you as practitioners to remember is these instruments should be tailored to the kinds of risks that you're looking to mitigate. What risk are you looking to solve for? What problem are you looking to solve for? Is it credit risk? Is it foreign exchange risk? Is it the perception of risk? So you have to be very clear in terms of what risk are you looking to solve for, and that should be the factor that determines the kind of instrument or the kind of tool that you need to then bring out of the toolbox and then deploy. Because Jason mentioned it's important to think about considerations when it comes to catalytic capital, I wanted to mention fund structures because I think that's something that you're mostly familiar with. You also spoke about that in the Japan ASEAN Women's Empowerment Fund transaction. We at Convergence looked at 240, I believe, different funds across the data that we collect. And we can argue, is the right sort of number? Should we be doing better? Should we be doing, is it as the best we can get? That's a different conversation. But we looked at the average and median leverage ratios. We looked at, for each dollar of concessional money in that transaction or in that fund, how many additional dollars of commercial or private capital were mobilized on the backs of that money. And we found the average ratio to be 1:4. When it comes to funds, it's important for us to think about two things. One is the concept of minimum concessionality. How do I know that this fund needs 15% first loss? Why not 25% first loss? Why not 5% first loss? Why first loss at all? So if you are a capital provider, when someone's coming and asking you for first loss within a fund or within any transaction, it's important to have them justify it or benchmark it or ask additional questions around it. It's a question of what we call minimum concessionality, not very well understood. similar to additionality. It's more of a science it's more of an art than a science. But you can think about minimum concessionality by benchmarking. It's also important for us to think about additionality. The argument is this precious development money, this concessional money, is being put into transactions because we are mobilizing private commercial capital into transactions that would not have otherwise been mobilized. We don't have a counterfactual in the real world. So how do we know that this money would actually not have been mobilized if it wasn't for me coming in and investing or putting my money to work on disproportionate terms? Again, as I mentioned, data, examples, case studies are the best ways to think about this. And I also wanted to share a document with you, and I'll put it into the chat box now. Hang on. That we worked on with the OECD to actually help. Let me send this, hang on a second, to everyone. Okay, so here is a sort of a guidance note from the OECD around minimum concessionality and additionality. Because we don't have too much time, it goes into it in much more detail than I have, but hopefully I've introduced you to the concept. But actually gives you a checklist and a guide around how do you actually think through these concepts to make sure that the transactions that you're supporting or you're structuring meet these specific criteria. Really, really important. And these are, to answer Jason's question when he asked me to speak, these are considerations for deploying catalytic capital. So minimum concessionality and additionality, really important points for you to think about. I'll skip through this, and Jason, you can send folks the slides when I send this to you after this conversation. I just wanted to cover a couple of examples in the interest of time, because I think examples are very, very helpful, very relevant. But before I leave, another thing I wanted to put into the chat box, and again, I'm trying to squeeze everything into the time that we have, so I am sort of rushing a little bit. Let me send this to you guys as well. Hang on. Yes, there we go. So you saw the Japan ASEAN's Women's Empowerment Fund earlier. For too long, blended finance has been a cottage industry. Every single transaction somehow needs to have individual bells and whistles, innovation for the sake of innovation, structuring for the sake of structuring, sometimes over-structuring. If we are serious about mobilizing private capital at scale, we really need to think deeply about standardization of transactions. We need to ensure that we have at least some benchmarking, some standardization, along with which we can design some of these transactions, be it private credit funds, private debt funds, or looking to mitigate off-taker risk, so on and so forth. Have a look at what I sent you in the chat box, because this is some work that we at Convergence have been doing over the last year, and we got some of this work approved and as part of the official communique at the Financing for Development Summit, because there was a recognition that, for the last 10 years since we were created, there has been a lot of innovation and experimentation in the space. And if I really am serious about mobilizing the Sanlams of the world and the APGs of the world and the Mitsui Sumitomos of the world, I need to have archetypical blended transactions that can mobilize these kind of institutional investors, because we are running out of time. So do have a look at these. These have been endorsed by a range of different governments, by the entire Financing for Development Forum as well. And now we're developing some action plans around this particular concept. So if you are looking at interesting archetypes for transactions, for examples that might resonate with your work, whether you're looking at public investment or private investment, this should be a good starting point for you. So I wanted to get that in as well before we wrap up, because as I mentioned, there's too many examples in the space, and a lot of them have a lot of bells and whistles attached to them, but not really, not a whole lot of scale. This platform that I'm about to talk about, Climate Investor One, that I think you can all see, is actually an interesting platform because It succeeded, and they've now set up Climate Investor 2, and then 3, and then 4. And Jason, you know them very well because they're South African. But essentially, it's a team of folks in South Africa that said, and remember that independent power project example that I gave you earlier. They looked at this transaction and said, where is the early stage risk for investing, or where is the risk for investing in these independent power projects? It lies at the early stage. So again, what am I looking to do? I'm looking to de-risk power projects, renewable transactions at the early stage of the life cycle. So what do I need? I might need a development fund, fully grant funded. Okay, let's put that together. So they got $50 million into a basket called the development fund. It's pure grant money, technical assistance money, that is then being loaned out on let's say it's called a 0% basis because they have to pay back to the various different projects. Go out and use the funding for project preparation, so on and so forth. Once they are ready to move to the construction phase, you have a construction equity fund. That's a 3-tiered fund. You've got donor capital from government agencies, that is the Japanese, the Germans, the French, the Brits, the Australians, the Americans and others. On disproportionate terms, you've got commercial capital from the various different DFIs on a mezzanine term. And then you've got institutional capital that was de-risked by the other 3 layers of capital. And that was $800 million going to the equity, the construction activities for this particular transaction. And again, once this transaction, once each of the underlying transactions were spitting out cash flows, were selling power to the grid, whether they were wind power, solar power, biogas, and so on. They had a separate fund that was capitalized purely by commercial institutions, by banks, by asset managers, and others. That was senior debt to essentially refinance the various different underlying transactions. So in this very elegant way, you are able to diversify across a range of transactions, because if there's currency issues in Mozambique, or if there is political unrest in Nigeria, or if there are any other challenges in Guatemala, you have a fund over here essentially that has diversified away a lot of that individual idiosyncratic risks that you can find in the country level. So you've got that diversification, and then with the subordination, the 3 tiers, you've also got risk protection and risk cushion for institutional investors and for commercial investors to expose them to an asset class that they would not have been exposed to otherwise. As I mentioned earlier, there's only 2 countries in Africa that have an investment grade rating, Botswana and Mauritius. Therefore, each transaction, every single wind transaction, waste to energy transaction, any other transaction in these countries, and I'm in Rwanda today, any transaction in these countries is 1 or 2 notches below the sovereign. So if I'm looking to get Allianz Global Investors, AXA, Sanlam, Old Mutual, PIC from South Africa and others to be invested in these transactions, it's impossible. They can't do it. So how do I show them product? How do I offer them a solution that works for them? That's something that has got diversification, that's got scale, that's got some credit enhancement, that's got a range of different tools that can mobilize them into underlying transactions that they would not have touched otherwise. So I just wanted to share this example with you. And Japan ASEAN Women's Empowerment Fund also is a good example of the Japanese government mobilizing institutional money in Japan. Japan still, to some degree, has a quite low interest rates, even though inflation has been picking up in Japan. They do have low interest rates in Japan. And therefore, Japanese institutional investors are on the lookout for yield. And then that kind of model is very useful to nudge them to invest in continents or in countries that they wouldn't invest in otherwise. Unfortunately, I got to drop off because I have another phone call, but hopefully I just managed to stimulate some thinking, inspire you to be interested in this topic. But unfortunately, I have to stop here. If you do have any individual questions, I'll be happy to field them via email. So Jason, please, you can drop my email in the chat box and I'll send you these slides as well. But unfortunately, I need to run. So thanks, Jason, Nazri, for inviting me, and everybody else for your time and attention. I appreciate it.
Thanks, Akif. Really appreciate it.
Thank you very much. Bye-bye.
Great. Thanks, everyone. That is 5 o'clock. Just a few notes from my side with the assignment, right? So next week we are going to conclude the kind of the 6-step process. So then you can really get started on the assignments. And so the assignments, we are going to give you, we're going to allocate you a peer in your cohort by the end of this week. And then you can then engage with your peer, start to get to know them, and then you can start already now going through the first few steps which we have gone through on your assignments. And then what we're going to do is we'll conclude the after session 6, right? You'll have a week from the end of session 6 to submit. So what you'll do is you'll submit the assignment plus your peer-reviewed form, which we're going to upload for you next week as well. And then you'll submit that, and then we'll review that and see that you have submitted both. And then we should be able to get your certificates to you following that after a week or 2. So just to give you a sense of the certification, we're going to look at the assignment, we're going to look at your participation, look at all the things on the platform, the quiz, the activities, just to ensure that that's all in order before we award certification. But also don't stress too much. Next week, we put aside some time where we can discuss the assignments. And if you've got any questions in that, please feel free to come with those then. All right. I won't keep you any longer. Thanks so much. Again, you've been incredible. The chat has also been really great. Lots of questions, and we are going to try to see if we can find some time where we can, any unanswered questions, and that we'll try to put aside like half an hour where we can just have a discussion and answer questions. So we are going to try to see with the timetable when we can do that. But thanks a lot. Thanks everyone. Enjoy your evening.